Hello and welcome to Switzer Investing Insights, brought to you by NAB Trade. And today we want to look at the second week of reporting season and make an assessment of how things are going. Paul, let's kick off with the big one, Telstra.
Yeah, let's start with Telstra. I mean, first half EBITDA down 16.4% to $4.3 billion. A story about an income drop there, Peter, down 4.1%. Big story coming out of Telstra was the dividend cut. Now, this wasn't totally unexpected, but it probably came a little sooner than many analysts had perhaps forecasted. It's important to remember that dividend, which is now 11 cents for the half year, comprises two amounts: 5 cents the ordinary dividend, that's coming out of normal earnings, and 3 cents per share still coming out of the one-off NBN receipt. So I think what we can say is that it looks like the dividend for Telstra for this year is 16 cents. The NBN receipts will last another couple of years, but there's still some doubt about what the Telstra dividend might be in a couple of years' time, unless they can really get their act together in terms of costs. Not a strong report, but there were some highlights. They reconfirmed their full-year guidance. I guess that's a positive. Some progress on cutting some of their fixed costs, and that's part of their ongoing program. And they reported a good increase in mobile customers, up 240,000 customers, and mobile revenue up 2.4%. So that's a positive. Negatives, actually, in terms of the same mobile customers, their average revenue per unit or per customer actually fell. So this is the problem in the mobiles market. More customers, but they're paying less, particularly as they're giving data away, more competition. And as I said, the dividend cut was probably earlier and steeper than some had expected. So bottom line, look, for me, Telstra is still a hold. I don't think the market's ready to re-rate Telstra. It really needs to demonstrate that it's going to plug that NBN earnings hole and really has taken the teeth to cutting costs.
One quick question: do you think the dividend where it is now is going to be stable, or will we see more cuts?
I think we're going to see 16 cents for this year and probably in financial year 20. Yeah. But I think there's still some risk after that.
Okay. Let's go to CSL, Paul.
Yeah, this result was perhaps... I think the CSL people thought it was pretty good. The market didn't like it quite so much, maybe because expectations were pretty high. Looked like CSL has got such a great track record, and again, first half NPAT was up 10% in constant currency terms to just over 1.16 billion US dollars. Sales up again 11% in constant currency terms, and a first half dividend of 85 US cents, up 8%. So the headline numbers all look pretty good.
Yeah.
Highlights, look, a strong result from their immunoglobulins and
well said, Paul.
I had to practice that one. And their Seqirus flu vaccines. Yeah. There were some parts of their blood plasma products that were a bit disappointing. Full-year guidance was actually raised. So CSL is a company that provides guidance. It previously had provided guidance for the full year of between $1,880 million US dollars and $1,950 million. They said that would now come at the upper end of that, so that's a positive, but maybe not as high as the market had been anticipating. So that's probably a negative, and the market actually sold off a little bit of the result. And there was also some concern about the composition of the result, because Seqirus, which is the flu, is very seasonal. It will actually lose money in the second half, so CSL said that. And I think they were expecting a bit better of some of the blood plasma products. So as a result of this, earnings brokers actually reduced their target price a little bit across the board. So that's probably why the market came off a little bit. Bottom line for CSL, such a great company. It's expensive, but you've got to stay long this company.
If you haven't got this stock, is it a buying opportunity now, or do you think there'll be some weakness?
I think I'd be waiting for maybe market weakness to get into. I think around $190 it's fairly fully priced, but I think the people who are long don't sell it. Okay. I think you stay along with CSL. It's still probably Australia's best company, and no reason to get out yet. Okay,
let's go to Woodside. I know Charlie Aiken was pretty keen on Woodside. How did it go?
Well, Woodside reported pretty well. In fact, it's doing very well. In fact, higher oil prices are boosting gas prices. Production is up, and has actually got a pretty good handle on its costs and its projects. So full-year NPAT up 28% to just over 1.36 billion US dollars. The big surprise was that it actually increased its dividend, Peter, to 141 US cents a share. That's a full year, compares with only 98 cents in 2017. Puts it on a yield of over 6%. Now we've seen mining and resource companies yield those sort of numbers before and have some ongoing challenges. So I think part of this was Woodside's cash is very strong, and they're also responding a little bit to some concerns about what to do with the potential changes in imputation credits, so giving people the money now. Highlights, good production numbers, up 9% to 91.4 million barrels of oil equivalent. Got that through. And this is why they're paying the dividend. The free cash flow was actually up 83%. Look, the negative, I think, is that the dividend is actually a payout ratio of about 95%. That's not sustainable. That's above Woodside's own target around 80%. Some criticism, they not only less than 12 months ago they raised capital, now they're paying back as dividend. But, they've done okay and they've obviously benefited from the higher oil price. I think the bottom line is you stay long this company. Oil prices to me look very firmly bottomed at about $50. I think there's no reason yet to get out of Woodside. They seem to be very much on top of their projects, but there's now going to be greater execution.
Do they have LNG potential as well?
Look, they do have a lot of potential. They're now getting into the phase where some of these projects are going to require to come into move to the execution phase. But they have said that by financial year 20, their target for production will be up to about 100 million barrels of oil equivalent. So I think there's a good company. The market has been a bit negative on Woodside, but that's one of the reasons I think the price has gone up. So perversely. So I thought this was actually a pretty strong report, but the dividend, if you're factoring that into your equation, that level is 95% payout ratio is not sustainable.
Okay, right. Let's quickly go through the positive and negative reports from this week.
Yeah, generally, look, I think more positives than negatives. You can see a list on the screen in front of you. I suppose there's a couple of takeaways. Amongst the negatives, basically been the financials. So we said both AMP and Suncorp are really paying the experience of the Royal Commission. I actually thought the AMP fund outflows were better than I'd expected, but the market didn't like it. Big dividend cut. Bendigo also disappointed. Tabcorp and Transurban also slightly on the weak side. Some of the industrials, companies like Amcor and Breville and
it's good to see, isn't it?
Have done better, and even South 32. So more positives than negatives, and I think reporting season hasn't done too bad so far. Yeah,
and it's interesting, Paul. Some of the companies that really have struggled have had, in a sense, government interference or inquiry interference. The normal companies from the economy position have been doing well, like Breville.
Yeah, absolutely. And so that's, I think, one of the reasons why the market's been able to find this done quite well and is still around 6,000.
Okay, so that's Switzer Investing Insights brought to you by NAB Trade. Thanks for joining us.